As the coronavirus punishes stocks, widely followed market voice, Allianz chief economic advisor Mohamed El-Erian warned against buying that dip. He made that call here on Squawk Box twice, first on February 3rd and again last Tuesday. Since then, the market has sold off sharply. Mohamed's back with us this morning on the Squawk Newsline, and we're also joined by Wharton School of Finance professor Jeremy Siegel. But Mohamed, I want to start with you. You have been telling people not to buy this dip to this point. We have seen the market's gone quite a bit deeper, quite a bit lower since then. What's your call this morning?
So it's no longer the easy call, Becky. It was easy because valuations, fundamentals, and technicals were either flashing red or yellow. Fundamentals were deteriorating very rapidly. People underestimated what an economic stock looks like, and policymakers were complacent. Valuations were elevated, and technicals were really dependent just on central bank liquidity. Now, rather than have two red lights and a yellow light, you have three yellow lights. So my advice to investors is very differentiated depending on the type of investor you are and what your initial conditions are. It's not the easy call that it was on the prior two occasions I was with you.
So what are you watching? What do you follow now? Is this a situation where you follow the economy or where you try and follow the case count and how things are handled here in the United States?
Depends who you are. So if you're a tactical investor or an arbitrage investor, this is an opportunity-rich environment for you. Technicals and command, you see this from the volatility we've experienced just over the last 12 hours in futures. You see this from what's happening in the fixed income market. You see this what's happening in the corporate market. There are a ton of opportunities. If you are confident about your ability to move quickly and if you can exploit arbitrage opportunities because of how indiscriminate the sell-off is. If you are a long-term investor, I would wait. I think fundamentals are going to deteriorate even faster. I think the tug of war between policies and fundamentals are going to go in favor of bad fundamentals, unfortunately, initially. So if you're a long-term investor and you're already heavily exposed, I would wait. If you're a short-term tactical investor, there's lots of opportunities out there.
Jeremy, what are your thoughts this morning?
Well, I'd like to first repeat what I said last week, and that is that over 90% of the value of a stock is due to its profits more than 1 year into the future. So as bad as this year can be, and I agree with Mohamed, there's so much uncertainty. I mean, we could really have a short, quick recession that could do havoc with earnings. The long-term value is not significantly impaired. Given that we were a little bit overextended at the end of January, so we're taking off that fluff, and now I think we're down to the position where you have good long-term value. So in my opinion, I say stay the course for all long-term investors. If you had a lot of cash, I would put some to work going forward. Let me also say, it makes no sense to me the Fed should have cash at 160, which is the funds rate, with the 10-year now at 1%. I mean, I understand that there's supply side disruptions as a result of the virus, but let's face it, this is mostly going to be a demand-induced slowdown. I mean, people are canceling trips, they're canceling events. It isn't because there aren't boats and there aren't venues and there aren't planes. It's the fear of getting the virus. So yes, I think the Fed can help, can cure it, but can help by going down vigorously, and I hope they will follow that course.
Jeremy, this is Liz Young. Just to follow on to your point, I think the market does trade more on expectations than it does on events. So at this point, with last week's drop, have we baked in all of that worst case scenario? And going forward, if we continue to get bad news, do we even really react to it? Is it already baked in?
Well, I think that some of it is definitely baked in. By the way, I think in the last segment, what was it, Dr. McCarthy? I thought he was tremendous. I think he was the author of Superbugs. I mean, what he was saying is we're going to see a lot more news about outbreaks here in the United States. The silver lining of that is that he believed that the death rate is much lower than the 2% that we've been getting so far, and that it might just be twice as bad as the seasonal flu. Now, a seasonal flu kills a lot of people, but I think that, we're going to get bad news. People are going to cancellation. I mean, he talked about canceling March Madness. Can you imagine that? What other events, conventions, conferences, seminars, schools? Wow, that bad news can still come. But again, looking beyond that, and I think we can look beyond that because, we've gotten over these bugs in the future, in the past. There's a lot of value out there at current levels.
Hey, Mohamed, one thing we haven't talked about much today is what might be happening behind the scenes, deals that were in the work, things that maybe get unhinged a little bit, or any freezing up of potential for people being willing to reach out and do some of those deals as a result of how quickly these numbers are moving. What do you think?
Becky, that's an important point because we know from experiences elsewhere, mainly in emerging markets, and we don't tend to look at that very much, that these sorts of economic sudden stops expose massive structural vulnerabilities both in the economy and in the marketplace. So look for liquidity stresses. When it comes to Fed policy, I think it's really important to understand what the Fed can and cannot do. It can fix market malfunctions, and it will. So look for it to be focusing on where the stress areas are. And that's going to be mainly direct liquidity injections. It will also cut rates, probably in a coordinated global manner, but that is going to be more impacting expectation than actual economic activity. As Jeremy says, whether interest rates come down or not, that's not going to influence whether you travel or not. So the interest rate mechanism will be used in a global coordinated fashion, but it's not going to be helping in turning around economic activity. What really matters from the Fed is whether it can fix market malfunction. And then finally, don't forget the fiscal side. They will target the medical profession because that's such a crucial sector to the recovery, and they will target the most responsive and most vulnerable segments. So that's another thing that investors should be looking at because there's going to be very targeted fiscal action around the world.